So what I'm going to try to answer in the next 5 minutes is a little bit of the question, why is an accountant here? What I'm going to do here is I'm going to basically combine a couple of papers that I have together with two co-authors, one at UCLA and one here at Wharton. And effectively what we're sort of trying to do is we're going to try to take Luke's work, and especially Luke's analytical work, where he sort of builds a capital market equilibrium, and trying to push this into a direction where managers make choices and where fund managers make choices. So in part, sort of what motivated us is the question, how do we lessen at least the impact of climate change? And the answer is incredibly simple, which is all of us need to change our behavior, which is also a very, very difficult question to sort of answer. Because we know that all of us don't typically change our behavior, so somehow we have to motivate people. Economists have done a lot of work in this area and basically figured out that pretty much anything that we can do is also very, very hard to do, right? Taxes are a four-letter word in politics. Taxes, as Arthur told us just a couple of minutes ago, may be the most effective way to dealing with this. So somehow we have to find other alternatives. Now, one of the things that Luke is trying to suggest here is that capital markets may be able to play a small role or a role in this. How big, we'll see. So the fundamental question here is, how do we deal with externalities, right? One firm's choice has an impact on other people outside of that firm. When you think back to your finance classes, externalities and the view of a portfolio is sort of inherently there when you sort of think about a CAPM or something, right? As an investor, all of our finance classes tell us, think of your portfolio. Don't think of an individual stock, just think of the whole portfolio. And then you say, wow, that means like the whole externality should be priced in, and that's great. So then let's talk about an externality. Firm A does something, and firm B sort of gets the effect of that. So where do we deal with it as pricing? Where do we see the externality? Well, if I buy firm A's shares, I get the impact on firm A's cash flows. I don't get B. If I buy A and then also buy B, I get B. But really, the externality I only see in the share of the price of the receiver rather than of the sender. And that's a problem, right? Because we would like to motivate the manager of firm A to not do a bad thing. So how do we get that? How does Luke get that in his model? The answer is relatively simple. We have investors that inherently care about the externality. I would like to buy green shares because I value green shares over and above just their cash flows. And all of a sudden, if that happens, I get pricing effects, and I get sort of the externality priced at A. That's great. So then what do we need? We need these investors to actually be informed. Right? A finance professor has a simple life. He just says everybody knows the greenness of every share. As an accounting professor, I have to say, wait a minute, that may not be the case. Somehow these people have to get information. Accounting, thank you. And so then we sort of have to worry about where's that information coming from? And typically what we see is information is coming from out of firms, and it's a result of managers' actions. So then when we get this heightened interest in greenness and ESG outcomes of firms, what we're going to see is we're going to see managers that care more about the information that's coming out. Therefore, they're going to take more actions that increase the information, therefore increase their price. And they're going to take more actions that make that information look better. Greenwashing, right? We typically see greenwashing as sort of a morally bad thing, and it's something that we need to avoid, and it's going to dampen our effects that we're going to have, and it's going to make everybody worse off. Typically, I would say when we look at an equilibrium model, what we're going to see is that greenwashing tends to be a natural outcome of providing incentives. If I want to provide incentives for change, I'm also going to provide incentives to make it look like I changed. But they tend to go hand in hand, and so typically we can sort of think about greenwashing and positive change as sort of things that go hand in hand with each other, and not necessarily just a bad thing. So then we started thinking more. Now, for the model to work, we need all of us to care. Great. So all of us care. Now let's say all of us care and we all have some money and we want to invest it. It is really hard to figure out which stocks are green and which stocks are not green, right? I cannot possibly update my beliefs over all of these firms and then change my portfolio according to that. So what do? I delegate my choice. Who do I delegate it to? Funds. So we can all go online, we can buy shares of funds, we can give our money to mutual fund managers, and they make the investment choices on us. That's great. So now let's say we have these investors that care. These investors that care, some green investors, delegate their portfolio choices to fund managers. And then we have green funds that trade in green enough shares, and we have regular funds that just trade in everything. Now let's say the fund managers, what we know about fund managers is that they like to have more assets under management, and fund flows tend to be driven by past returns. So I'm going to put all of that in a model, and then we say the green funds only hold green enough shares. The regular funds is going to sort of trade freely. They're basically going to absorb, they're going to clear the market on the green shares, and they're going to hold everything for the brown shares. As long as they take any frictions out of the market, there's no greenium, there's no premium, there's no benefit of being green. The only thing that's going to happen, everybody's going to earn the same expected return, and green investors are really happy because they get the same expected return, but they also are really good and they only hold green shares. So in the end, what that leads to is what we need incentives for fund managers to actually start investing green, not just investing above a threshold, but actually buying a more green firm. And for that, we need information, and we're back to the reason for accounting to be here in this room. Thank you.